Hello friends and welcome to the Coin Engineer YouTube channel. The 15th video of our Introduction to Technical Analysis series is the candlestick charts and how to use them. But before we start, please click on the subscribe button, turn on the notifications and follow our other social media accounts to not miss out on the latest news and upcoming events. Now let's get started. Candlestick charts are a technical tool that packs data for multiple time frames into single price bars, and this makes them more efficient than bars or simple lines that connect the dots of closing prices. Candlesticks build patterns that predict price direction once completed. Proper color coding adds depth to this colorful technical tool, which dates back to 17th century Japanese rice traders. In the 70s, a Japanese man named Honma discovered a link between price and the supply and demand of rice, and the markets were influenced by the emotions of traders. Candlesticks show that emotion by visually representing the size of price moves with different colors. Traders use candlesticks to make trading decisions based on regularly occurring patterns that help forecast the short-term direction of the price. There are more than 50 candlestick patterns, but in this video we will show you the most famous ones. Now let's start with our first candlestick pattern, hammer. The hammer candlestick pattern forms a short body with a long wick found at the bottom of a downtrend. A hammer shows that there were selling pressures during the day and eventually some buying pressure will drive the price back up. The hammer candlestick pattern forms a short body with a lower wick found at the bottom of a downtrend. A hammer shows that there were selling pressures during the day and eventually some buying pressure will drive the price back up. We have the inverse hammer, and the only difference is the upper wick is long while the lower wick is short. It indicates a buying pressure followed by a selling pressure that was not strong enough to drive the market price down. The inverse hammer suggests that buyers will soon have control of the market. We have the bullish engulfing. The bullish engulfing pattern is a combination of two candlesticks. The first candle is a short red candle engulfed by a larger green candle. Essentially, this green candle might become a signal for a bullish price movement in the market. On the piercing line, if the green candle reaches up the mid-level of the previous red candle, then the next candle might be in a bullish direction. There is usually a significant gap between the red candle's closing price and the green candles open. It indicates buying pressure as the price moves up to the mid price of the previous time frame. Morningstar is a three-stick pattern, one short-bodied candle between a long red and green. It signals that the selling pressure of the first candle is declining and a bull market might begin. The three white soldiers pattern consists of consecutive long green which opens and closes progressively higher than the previous candle. It is a strong bullish signal that occurs after a downtrend which shows intense buying pressure. The rising tree method comprises three short reds between the range of two long greens. The pattern shows traders that despite some selling pressure, buyers are retaining control of the market. The hanging man is the bearish equivalent of a hammer and it has the same shape but forms at the end of an uptrend. It indicates a significant sell-off during that specific time frame, but buyers manage to push the price back up again. This sell-off is an indication that the bulls are losing control of the market and the bears might get the market control again. The shooting star is the same shape as the inverted hammer but formed at the end of an uptrend. It indicates that the price might start falling again as the trend might changes. A bearish engulfing pattern occurs at the end of an uptrend when the first candle has a green body engulfed by the second red candle. It signifies a slowdown in the price movement and an upcoming change in the market price. The lower the second candle, the more significant the trend is likely to be. The evening star is the equivalent of the bullish morning star. It is a short candle between a long green candle and a large red candle. It indicates the reversal of an uptrend and is particularly strong when the third candlestick erases the gains of the first candle. The three black crows candlestick pattern comprises three consecutive long red candles with short or non-existent wicks. Each session opens at the similar price of the previous day, but selling pressures push the price lower and lower with each close. Traders interpret this pattern as the start of a bearish downtrend as the sellers have overtaken the buyers during the three successive periods. The dark cloud cover candlestick pattern indicates a bearish reversal. It contains two candlesticks, a red candlestick that opens above the previous green body and closes below its midpoint. It signals that the bears have taken over the session and they are pushing the price sharply lower. Three method formation patterns are used to predict the continuation of a trend to be it bearish or bullish. The bearish pattern is called the falling tree method. It is formed of a long red body body followed by 3 small green bodies and another red body. The green candles are all contained within the range of the bearish bodies, and it shows traders that the bulls do not have enough strength. That is it for today. I hope you have enjoyed our content. If you did, please drop a like under the video, and if you would like to see more of our content, please click on the subscribe button. Thank you for watching and take care until next time.